Hi, Else here. Today I'll be covering why and how to allocate service department costs. But let's start with a blast from the past, just to remind you about past terms or concepts that you'll need. Overhead are those costs required to run a business, but they don't directly lead to the generation of profits. Overhead is also known as burden or indirect costs. They are indirect because they can't be directly traced to any specific business activity, product, or service, but they do provide critical support for the generation of profit-making activities and are therefore necessary. Overhead costs tend to be fixed, which means that they don't change from period to period or with the level of activity. Examples are rent and depreciation. However, total overhead is generally a mixed cost made up of both fixed and variable costs. It should also be noted that overhead costs can make up a large portion of the company's overall costs. As such, the allocation of these indirect overhead costs becomes critical to a company's overall success. A cost driver is an activity that, when it changes, causes a change in the costs. For example, the number of square feet in a building will drive the cost of janitorial services. Why? Because the more square feet there are, the longer it takes to clean the space. More space equals higher janitorial costs. Specifically, a cost driver is an activity that is the root cause of why a cost occurs. Companies that want to know the true costs of their products and services need to know what is driving their indirect overhead costs. For this reason, the company may use multiple cost drivers to ensure they get a better idea of what's driving their costs. Now that I've reminded you about some basic terms, let's move on to an important question. What is a service department? Well, to understand service departments, you first have to understand operating departments. Operating departments, also called profit centers, or revenue-generating departments, or producing departments, are directly responsible for creating goods or services, and these will be sold to external customers or clients. In manufacturing, the operating departments are the ones that work directly on the products being manufactured, such as grinding, machining, and assembly departments. In a wholesale or retail business, operating departments are responsible for selling merchandise to customers. And in a service business, operating departments provide services to customers. In all of these examples, the operating department generates revenue for the business. Service departments, also called cost centers or support departments, provide services to support the business's operating departments. Examples include maintenance, information technology, custodial services, accounting, marketing, general administration, and human resource departments. These departments are critical to the running of the business. In fact, businesses could not exist without these departments, but they don't, in and of themselves, generate revenue. Once a business has identified their operating and service departments, they can trace the direct overhead costs, direct to the department, but indirect to the product or service. These are costs that belong exclusively to each department. For example, the IT department would have direct costs such as salaries for the individuals who work in the department, supplies, depreciation on the equipment the department uses. All of these costs are directly traceable to the IT department, but indirect to the product or service the company actually produces. Great. Now we have operating departments with their own direct overhead costs and service departments with their own direct overhead costs. Using financial accounting standards, either IFRS or ASPE, how should the business record the direct overhead costs for service departments such as marketing and human resources? They are treated as period costs, basically operating expenses, when preparing the financial statements for external reporting purposes. Period costs are excluded from inventoriable costs by financial accounting standards. They therefore appear as operating expenses on the income statement. Why are we trying to allocate service department costs when accounting standards clearly indicate how they should be reported? Because managerial accounting is not concerned with external reporting, but with measuring, monitoring, and motivating behavior in a business environment. Support department costs are allocated for objectives, reasons, other than financial reporting. Let's look at some of the reasons for allocating support department costs. First, Support department costs are allocated to provide information for strategic and operating business decisions. For instance, pricing of products and services would be one example. Because operating departments are the only departments whose activities generate revenue, the price of the goods or services they produce must cover all of the costs, including the cost of service department activities. Full costing requires that all period costs be allocated to the product or service on some reasonable basis. This is not only true for existing products, but also new product or market introductions. Another strategic decision that requires full costing is whether a product or service should be outsourced. For instance, if a business made a decision to outsource the production of a component, then knowing the full cost of that component is critical in order to make a decision. Strategic and operating decisions are an important objective of allocating service department costs. Second, support department costs might be allocated to motivate managers or employees. By allocating service department costs to operating departments, it ensures that managers are aware of the fact that their activities result in costs outside of their own department. It also provides incentives for the managers to use the services provided efficiently and appropriately. Inefficient use of service departments' resources may result in higher overall costs. Motivating management and employees is another critical objective of allocating service department costs. Third and last, service department costs might be allocated for reimbursement purposes. What does this mean? Contracts with external customers to provide goods or services may stipulate which costs will be reimbursed and which must be excluded. For example, universities may be permitted to allocate a portion of the overhead costs for service departments to federally funded programs. Allocating service department costs will therefore increase the amount of funds received. This type of reimbursement is common with government contracts. You can see that all three of the main objectives for allocating service department costs have nothing to do with financial reporting, but they have a lot to do with managing the business for decision making. Now that we understand the importance of allocating service department overhead costs with regards to business decision making, what methods can be used to allocate those costs? There are a few, and when deciding between methods, the most important thing is being able to justify the method you choose to allocate those costs. In fact, the justification is one of the ways we choose the method that we actually use to allocate service department costs. There are basically 4 criteria that will help to justify your cost allocation decisions and therefore help you to choose a method. 1. An activity of the operating department causes the cost to happen and can be tracked. 2. The operating department clearly receives the benefit, which is an outcome of a cost. 3. The cost is reasonable or fair given the circumstances. And 4. The operating department has the ability to bear the cost. Businesses generally use one of these to support their allocation of service department costs and their choice of a method. We'll only explore 2 of these, number 1 and number 4. And I'll be doing that in the next video.